For more on housing now, let's bring in Zillow co-founder and former CEO Spencer Rascoff. Spencer, great to talk with you about this. If you own a home or two, this is all good, especially if you want to keep them. But most people are not necessarily in that position. So how does this end, you think?
Yeah, I mean, Diana's analysis, as usual, is spot on. We are just going to continue to see home price appreciation as long as we have limited supply. We're going to continue to have limited supply as long as municipalities have anti-development housing strategies and as long as there's mortgage rate lock-in. And as Diana points out, most people can't afford their current home, which means that even if they're no longer in the home that's right for them, they can't really sell because they couldn't afford the new higher rate. So we're starting to see some thawing a little bit. Inventory is now growing about 1% per week. New listing volume last week was up 18% from a year ago. So it's possible that some homeowners who are in the wrong home are starting to capitulate and just decide to list, even though they're going to have to trade up to a higher mortgage rate. But we're going to continue to see appreciation rates, 5.5% year over year this past month in February, as long as we have limited supply.
Yeah, but that seems so unsustainable. Let me put it this way. Either we're going to have to rewrite the American dream, right? Or prices are going to have to come way down. I mean, wages have already gone way up. They can't go up too much more, too precipitously. Or these prices are going to have to come way down for this affordability issue to get solved. So what's going to happen here? Which?
Well, we are starting to rewrite the American dream. I know that sounds kind of sort of depressing and maybe hyperbolic, but I mean, people are pushing out, first-time homebuyers are pushing out the time in which they buy their first home. It used to be in their late 20s. Now it's moving into their mid and late 30s. And people are increasingly house hacking. And a good example of this is co-ownership. And we saw this in the Wall Street Journal today. Two billionaires, Steve Wynn and Thomas Petterfy, they announced that they're buying a $110 million home in Aspen together. And, this is what my company Pacaso is all about. It's about creating co-ownership. And we're seeing it even at these incredibly high price points of over $100 million where people are saying, hey, maybe it doesn't make sense to own all of a home myself. So house hacking, buying homes with people, co-owning homes. These are and pushing out the time that I might buy my first home. These are some of the ways that people are adapting to these very low inventory environments and high mortgage rates.
Yeah, we saw that article too. I had a similar back and forth about this within our show team. Of course, it raises the question, what does this mean for Pacaso, which you co-founded, which we know is growing and which we know just a couple of days ago announced a pretty broad expansion into lower priced housing?
It's great news for Pacaso. I mean, Pacaso tries to solve this issue of housing affordability. The only two ways to solve the housing affordability crisis are either, number one, to build more homes, or number two, to better utilize the existing housing stock. And that's what that's what Pacaso focuses on, which is better utilizing the existing housing stock. The way we do that is through co-ownership. So we're having our UberX moment right now, where we're dramatically expanding the number of markets we're in. We just launched 200 more markets, 20,000 more listings. And it's working. Already, searches are up 265%. Mobile sessions are up 150%. Home detail page views are up 50%. Homes followed are up 75%. And so we're already seeing people start to place deposits on these homes in all of these new destinations that we've launched nationwide as we rolled out hundreds of new markets.
Okay, I got to shift gears here a little bit with you, Spencer, because we're very focused on this Disney proxy fight, the shareholder vote that's taking place over these next couple days. It's not the only company that is seeing a very contentious proxy season either. We know activist investors have been very, very busy this year, much more active than they've been in recent years. As somebody who has co-founded a number of companies, who's run a number of companies that were publicly traded, who's been on the board of a number of companies, just want to get your thoughts on this landscape that we're in right now from a governance standpoint, from a management standpoint, from an investor standpoint.
So it's very case specific. I mean, obviously, there are some companies that are mismanaged, and activists serve as a great catalyst to get those companies to pay attention and get management teams and boards to get their act together. There are other companies where, let's face it, activists are making a stink and front running their book in order to try to get the price to appreciate, and then they dump and run. I think, for me as a manager, as a former publicly traded CEO, I tend to err on the side, or I tend to fall down on the side of management in general, if we're speaking in generalities, as compared with activists. I think a lot of activists are short-term oriented, and they're trying to get the price up in the near term. management teams are trying to manage the stock price for the long term, which is really what this should be all about, is not short-term stock price impact, but long-term appreciation. With respect to Disney, it looks like long-term is winning out over short-term. It looks like management is probably going to win this proxy battle. And, you know, the activists will not win, although activists sort of always win in a way. It's a kind of a heads you win, tails they lose kind of situation, because if management ends up winning these types of battles and the stock price appreciates, then activists win in any event.